Welcome, ladies and gentlemen. This is the Unit 4 seminar, Macroeconomics. Tonight we're going to talk about the big picture and national income accounting. Okay, begin with, let's quickly review what you covered in Unit 3. Remember, in Unit 3, we were looking at the difference in supply and demand, and we saw what would happen if you had a supply schedule and a demand schedule. And then what happens if there's a market price that's set different than the equilibrium price? And we saw that in the case here where the market price is below equilibrium, that there's going to be a shortage. Why? Because at this lower price, consumers are going to demand a lot more, in this case 50 units. But at this much lower price, the suppliers only want to supply 10. So we have a shortage. Okay? We see that there will be pressure to move back to the equilibrium level because as consumers who wanted to buy 50 at that much lower price, some of those consumers will be willing to raise the price, if you will, bid the price up a little bit. And some of the suppliers would be willing to accept that slightly higher price than the earlier $20 price. And so gradually we'll have consumers bidding up the price and suppliers being willing to supply more until we get back to that stable equilibrium point. Okay? And then we saw that we could have something happen where there are many more consumers, and this would cause a shift in demand, in total demand, and I think the example we used is that we were able to offer our product to a second country. Okay, so now we had the original demand curve, the blue one at D1, and the combined demand curve at D2, which would be the total demand of both countries. Of course, the individual country supplying this product will see an increase bidding up of the price again, and at this new higher equilibrium price of $50 instead of $40, they're going to be willing to supply a lot more. Okay, and but then the question becomes, what about the original country? They still have their original demand. And what happens now is they're stuck with the new equilibrium price, which is much higher. And at this higher equilibrium price, the original demand group or country are willing to demand fewer. So we see on this chart of numbers at the bottom, the supply schedule and combined demand schedule, we see we have a new equilibrium price of $50 from the original $40, and the original demand group, D1, they had an equilibrium price of $40 and they were willing to buy 30. And now at this new higher price of $50, they're not willing to buy 30 anymore. They're only willing to buy 20, even though the total demanded equals 40. So you see how that works. Then we looked at the marginal opportunity costs, and we saw that we had increasing marginal opportunity costs because the initial group of fish, 20 fish, would only cost 5 coconuts. But by going to the second group of 20 fish, they had to give up all of their coconuts, and so it cost them 25 coconuts. So what we were seeing there is that in producing a particular product, we're going to use the best resources for that product first. Okay? And as we want more and more of that product, we have to use resources that are less well suited to producing it. And less well suited resources means much more expensive resources. Okay? And this would cause us to have increasing marginal opportunity costs. And of course, that implies that the production possibility frontier curve would be bowed outward and to the right. So if you have any questions, be sure to let me know. And what we're going to talk about tonight is national income determination, actually macroeconomics, the big picture. Okay, so we're going to start off with the big measure that we use in measuring economies is what we refer to as gross domestic product. And what gross domestic product is, it's the dollar value of all the final goods and services that an economy produces. Now, we have a pretty good idea of what goods are. Goods are things that you can buy. Okay, think of food, think of cars, think of gasoline, all the things that you can buy, clothing, your newspapers, anything that's physical. Okay, but our economy also produces intermediate goods. And what an intermediate good is, and we don't count that in our gross domestic product, but think of an intermediate good as something that we have to get that is part of what we're making. Think again of the car. So the car producer's producing a brand new car, they got to have tires. They don't make the tires, they buy the tires from a tire manufacturer. Now, we're not going to count the price of the tire, then count the price of the car separately with the tire included. If we did, we'd be double counting the tire. So what we do is we consider the tire to be an intermediate good, and we don't count its value as part of the production of the car. We count the total value of the car, what we're selling the car for. So therefore, intermediate goods are not counted. Now, tires that are sold to people to replace tires on their cars, those are counted because that is a final good going to the person to replace an earlier, damaged tire or what have you. Okay, so we also have services. Think of the, you go to a doctor, you go to a nurse, you have someone that's providing you some kind of service. Someone comes to your house to mow your grass, okay? Or you have an Uber driver who comes and picks you up and takes you somewhere. All those things are services that are counted in our gross domestic product, okay? So, and we measure this gross domestic product. We can measure it for the entire country, which is what we normally do. Okay, we could also have subgroups of that, but think primarily that we're measuring it for the entire country, and we measure it for some particular period of time. Normally, we're getting gross domestic product numbers on a quarterly basis, every 3 months, definitely every year, and oftentimes the values per month are available. So if we look at, per year or per quarter, that's normally the time frame that we'd be dealing with. Okay? Now, there are some things that are not included in the gross domestic product, okay? And these specifically, and I think you even have a question relating to this, are things that are, if you grow it at home, basically. Think of that. You have a little garden in your backyard. You grow some spinach, you grow some tomatoes, whatever. When you eat those, they don't get counted. But if you go to the supermarket and you buy some tomatoes and you buy some spinach and you buy some, whatever, that gets counted. That's part of our gross domestic product. But what you grew at home, not counted. I mentioned earlier, if you hire someone to come cut your grass, that's counted. But if you send the kids out to cut the grass, that's not counted, or dad. That's not counted because we don't have a way of measuring that. Now, you'll notice the picture in the upper left. There are many illegal things that are not counted. Why? Because we don't have any way of keeping track of that. It's real hard to get, illegal drug dealers to report how much money they've made on selling drugs. Not going to happen. So any illegal thing going on is not counted, obviously. Okay, so why do we even measure gross domestic product? Well, in a way, it gives us an idea of what the standard of living is for our people, for our population, okay? So, if we look back over history, and this goes back about 100 years, this particular slide, and you see this gradual increasing with some bumps along the way of our gross domestic product here for the United States. Now, if we look back 100 years ago, people lived quite a bit differently than they live today. If you look at this image, you're not going to see a microwave oven. You're not going to see cell phones. Things were a lot different 100 years ago compared to the way things would be today. Much more modern. We have a lot more things than people had back then. Okay, so therefore, our standard of living has improved. Even a very poor person in our country are much more likely to have electric conveniences that their ancestors could never have thought of. Okay? That is an indication that over that period of time, our gross domestic product has increased significantly. Now, you may remember that we have circular flow, and we'll be going through circular flow discussions periodically. This is a very simplified version where we basically have we have a business, consider it Walmart, that represents all the businesses in the country. And so you're the worker that they have to hire. You represent all the people. And so if they want to sell anything, they need workers to do that. So they're going to hire you and they're going to pay you to do the work, right? But you also represent all the people, and so you are the buyers. Okay? So what's going to happen is you're going to offer your service as work through the market for labor. They're going to have you doing things to sell to the population, but you represent the population. So as you get paid, you buy things, spend money, right, through that market for goods and services. Those are all the things you buy. That money goes to Walmart. Part of that money that they pay to Walmart is going to go to pay you for your service, for the work you do. Now, if you think for a minute, every dollar going into Walmart from people will ultimately go back to people somehow. It's either going to go to the workers through the pay, through the managers through their salaries. Okay, it may go to the companies that Walmart bought all that stuff from, but ultimately those companies are going to have to pay their workers and their managers. So again, they're getting paid. And the owners of the companies are going to make some profit, and they will have had to have paid for the raw materials it took to make those things. So let's say that you were buying a wooden piece of furniture, okay? That wood had to come from somewhere. Wood comes from trees, okay? The trees have to grow on somebody's land. If you take the tree off the land to build furniture from it, you gotta pay the person who owned the land. They get paid rent. Okay? So, and what about the money to get the business going, right? Somebody had to save money and invest it in the business to get it started and to keep it running. And yes, they have the money coming in from their profit. But ultimately, that investment had to come from some kind of savings where people did not spend every penny they had. Instead, they set some of that money aside as savings, which could then be invested in starting the business that made the furniture, that bought the wood from the landowner, that made the furniture, that sold it to Walmart, that you ultimately bought. Okay? So where did the money go that went to Walmart? It either went to the workers through wages and salaries, or it went to the investors in terms of profit, or it went to to the owners of the business in terms of profit, or it went to the people who saved money in terms of interest, or it went to the people who owned the land in the form of rent. But ultimately, it went to people. And that's what this circular flow diagram really tells us. Okay, so one of the things is we use a version of this circular flow diagram to compute gross domestic product and what the pieces of that gross domestic product are. So we start off measuring gross domestic product by looking at the consumption that people do, how much consumer spending there is. So we go to all those households, and all those households spend part of their money on stuff, on whether it be food, clothing, a new car, internet service, whatever. They spend money on goods and services. All that money goes to firms. Again, all the money is going to come out of firms in the form of either wages and salaries, dividends, which is profit to the owners, interest, which goes to the financial markets, to the people who saved money, and rent to the owners of land where the raw materials came from. And so all that money ultimately goes back to people. Now, when people get money in, they spend part of it, but part of it they save. And part of it they pay taxes to the government. Okay? So the next piece of the flow of the gross domestic product is how much money the government spends, because they take in our taxes and they buy stuff with it. They're going to pay for government workers. They're going to buy guns for the military, guns and ammunition. They're going to spend money on infrastructure, building roads, building whatever, maintaining roads. And a lot of that stuff they're going to have to go through the market for goods and services to buy. Part of the money that the government takes in, it gives to other people. We call that government transfers. That's money going from the government back to households. Think of your retired relatives. If they're old enough and retired, they're getting Social Security payments. Social Security is a payment from the government for people who are no longer working. Now, yes, people paid into that all their working career through taxes they were paying. Now the government's paying them back. Okay, so that's a government transfer. Now, sometimes our government spends more money than it makes, than it takes in taxes. In that case, it has to borrow money. It borrows money from the financial markets, but ultimately that's money that the households have saved. Okay, and so by households buying government bonds. Now, as an aside, it might be interesting for you to remember that the last time that the federal government spent less money than it collected in taxes and actually had extra money left over, okay, was when President Clinton, his last year in office. How long ago was that? Quite a while. Okay, so ever since then, our government has been borrowing money each year to buy all the things it buys. Okay, so we have government expenditures. That's part of our gross domestic product. We also have investment spending. Investment spending is where businesses, buy trucks and computers and, buildings and all the things it takes for the businesses to run. Okay, that money's got to come from somewhere. It's going to come from people who have saved, whether it is the owners of the businesses or whether it is, investors who hope to make a profit from the business. Whatever. The money comes from the financial markets. Okay? Well, that's something we have to consider also. Now, included in investment spending, you'll see this a little bit later, is new home purchases. Now, this is when a brand new home is built and the first people who buy that home, that investment spending is counted. Now, when they sell the house and somebody new buys the house that already had been bought, that's not counted because the house was counted when it was built. We'll talk more about that later. Okay. And then the last two, oops, click back again. The next element is exports. Many of the things that we make as a nation, we sell to other countries. Think of Boeing aircraft. Okay, so we export stuff. We sell to other countries, things we make, but we also buy stuff from other countries. Imagine that if you were today, walk into your closet and take a look at any 10 pieces of clothing in your closet, and you look at where it is made. Odds on, at least 9, if not all 10 of those items of clothing were made in a foreign country. Okay? Why? Because foreign countries have lower labor costs, and therefore we can get the clothes at a much lower cost to us, and therefore we buy the less expensive clothing. Okay? Than if we had to pay our workers in our country to make those same clothing, which, by the way, we had all our clothes made in our country up until the 1970s. Okay? And then starting in the 1970s, the textile mills in the southeast started moving gradually overseas. Okay? And all those textile workers lost their jobs that worked here in the States. So now with this exports and imports, if we import more than we export, well, regardless, we have to subtract how much we import from how much we export. Okay? And we'll see that calculation in a little bit. So our gross domestic product, measuring the way we're doing it here, is consumer spending plus the money that the government spends, plus investment spending, plus our exports minus our imports. Okay, so you're going to have some calculations very similar to this. There's going to be a hypothetical country giving you a set of numbers, very similar to what we're going to do here. Okay, and we're going to measure consumer spending first, and again, it's going to be household purchases of durable goods. Durable goods are things that last a long time. Okay, a wash machine, a dryer, a dishwasher that's going to last hopefully many years. Okay. We also have purchases of non-durable goods, things that are going to be used up very quickly. A dozen eggs, some food, some clothing, or things that may not last more than 6 months. Okay, we consider those non-durable. And then, of course, we have the services. You go to the doctor, that's a service. You use Uber, that's a service. So, those elements, you would add those 3 elements to get consumer spending. To get the investment spending, okay, we're going to count purchases that businesses make of capital equipment. We also measure inventory changes. Now, inventory changes is basically what inventory is left over at the end of the year. Okay? Because during the course of the year, they build up their inventory, they sell the items. They build up more inventory, they sell the items. But sooner or later, we get to the cutoff period for our accounting records, and we have to count that as a cutoff point. And so that's our inventory change. Okay, if we have inventory left over, it's a positive thing. Yes, we made that. That counts in our gross domestic product. If the businesses have built new buildings, that counts. And then remember that I said that people who buy a brand new house, their brand new house counts. Okay, so we have 4 elements that go into investment spending. Okay. Then we have the government spending. Basically, in this instance, we're only measuring government expenditures for the salary of government workers, and then any expenditures on public works. Okay. Then notice that we have a couple things that are not counted anywhere in this. One is depreciation. Okay. If you've already had accounting, you're probably familiar with what depreciation is. A business gets credit for having used some of its equipment. So for instance, you buy a truck, and to run in your business, the truck is expected to last 3 years. Each year you can subtract 1/3 the value of that truck as an expense in your company that you are no longer able to have that value because the item has depreciated. Okay? So we don't count that in our measurement of gross domestic product. Also, we mentioned earlier that the government has what's called transfer payments, where the government collects taxes from some people and gives money to other people. Think of the Social Security. Well, that money coming in as transfer payments is not counted separately. Why? Because we counted it either in the household purchases of the people who received it, okay, and or the investment money. So it's counted there. It's not part of the gross domestic product. Then we have our foreign purchases, the exports, if you will, what we sell to other countries. So we have to measure that, and then we have to measure how much we bought from other countries, and we have to subtract how much we bought from other countries, our imports, from our exports, and we end up with a net export number. You'll notice it's in parentheses, which means it's a minus number. So in this example, we exported, or the country exported $1,000, but bought $1,800 worth of stuff. So it had lost $800 of gross domestic product. So that should be very similar to an assignment problem that you're going to have. You got your total gross domestic product, merely adding up those numbers. In this case, 46,600. Okay, I think that should help you a little bit. So let's talk a little bit more about this gross domestic product growth. Okay, and the question is, we're seeing a number go up. Okay, the question is, are we actually producing more things, or are we just seeing higher prices for the things we're already producing? So think of this basket of goods that the lady on the right is doing. If we go back about 50 years, a little over that, in the neighborhood of 52, 53 years ago, the standard basket of goods, we call this consumer price index method, and you'll learn more about it a little bit later in the course. But a standard basket of goods would cost about $30 a week for a family of 4. Okay. Now, it's not just the groceries you see in the basket, but that's a pretty good example. It also includes clothes and transportation and things like that. But the problem is, to take care of that family of 4 for a week today, okay, is $215 instead of $30. Now, the dozen of eggs that the lady's buying are not better eggs than they were 50 years ago. They're the same. A gallon of milk 50 years ago, same as a gallon of milk today. No real difference. Yes, if you look at cell phones, for instance, or communication, we didn't have cell phones 50 years ago. Today, we got cell phones, okay? And yes, they cost money. So that would be an example of something that has come in to the basket that wasn't there before. That would, cause the value to go up. But again, we account for that by periodically changing that basket of goods, okay? So, but think of the half a gallon of milk that no longer cost what it cost 50 years ago. It costs 3 or 4 times as much or more. Okay, that's inflation. Okay, and inflation is something that we have to account for. Okay? So another thing that we can do, and we have a way of doing that, where basically we subtract out the inflation, and that lets us compare what prices would have been a certain time ago if we equate what it would buy in a particular year, and how much would it take today's dollars to buy the same amount. We can eliminate the inflation by measuring that, and you'll see that a little later in the course. So another thing we can do with our gross domestic product is we can compare different countries. Okay? So, for instance, we can collect data on what the gross domestic product, or in this case, gross domestic product per person, is in various countries. And if you look at this chart, you notice the United States in 2007 had roughly between $45,000 and $46,000 per person coming in. That does not mean every person made that amount of money. What it means is if you take the total gross domestic product for the country and you divide it by the 300 and some million people we had in 2007, if each person were to get an equal share, that's how much they would have gotten. Okay? So it gives us an average measure. But we can compare different countries that way. So if you notice that Bangladesh in 2007 had only $1,241 per person compared to our $45,592. Big difference. Okay? So, comparing gross domestic product, you see, can reflect the level of the standard of living of people in those countries. Okay? Okay, if you have any questions, please get a hold of me, shoot me an email. My emails pop up on my phone immediately, and so I get them very quickly. You do not need to go to the classroom and the digital office thing. Just get a hold of me on my cell phone. Shoot me an email or shoot me a text, and I get that, and I can respond to you. Okay, so if you have any questions, be sure to let me know. And what you have to do, of course, your discussion thread has you listening to a new podcast, and hope you're finding those interesting. And we'll be talking about those. Remember your first post by Saturday at midnight. We're back on a regular schedule this week, even though we lost Wednesday. Post on 3 different days. Answer the question, and make sure to include a reference to where you received the podcast from, and make sure you respond to at least 2 of your classmates. Your reading for this week is chapters 6 and 7, Macroeconomics, and information about the gross domestic product and the CPI. Your assignment for this week has you looking at and making calculations on the gross domestic product. Either this week or next week, it will have you discussing what things are not included in gross domestic product. And it'll have you looking at inflation and the difference between intermediate goods and final goods. Okay. And with that, you know how to contact me. You have my email address and you have my cell phone number. Remember, text me first so I know it's not a scam call. Otherwise, I don't answer if I don't recognize the number as a student. And with that, thank you all very much. We'll see you in the discussion threads, and we'll see you next week in the seminar. Thank you.